Today, I want to show you 3 dividend stocks that I find very interesting right now and that are quite cheap. So, regardless, if you would like to lock in a nice dividend yield or have been looking for stocks with a reasonable valuation, these 3 might be worth a deeper look. One of them even has an impressive dividend yield of 6.5% with great growth chances. And I would almost guarantee that you don't have this one on your watchlist yet. So, without any further ado, let's get into it. My first pick is Louis Vuitton Moet Hennessy LVMH. They are one of the world's leading luxury goods manufacturer and own over 75 brands in different sectors like fashion, cosmetic, jewelry and wine. These brands include many well-known names like Dior, Dom Perignon, Sephora, Marc Jacobs or Loewe. China is an important market for them where they generate around 1/3 of their revenue, and their current weak economy has also hurt LVMH quite a bit. At the moment, the stock is trading more than 25% below their all-time highs. But with China's policymakers now trying to boost their economy, LVMH's China business could soon return to its old growth trajectory. Over the last 10 years, LVMH did deliver returns of over 530% to their investors, which easily beat the S&P 500 here in red. It did also outperform the Nasdaq here in blue over the same time, although the difference between these two has shrinked quite significantly with the recent sell-off of LVMH. This sell-off is very apparent in the 1-year chart, where both indices could easily outperform the stock. Over the last 12 months, LVMH had quite a poor performance with minus 7.5%. And this already includes the dividend. When we compare the 5-year performance with their 2 most prominent peers, Hermes and Kering, it sits right in the middle between the two. But its performance has been on par with Hermes over the first half of this time frame and has only fallen back during the last 2 years. This weakness is also visible in the last quarterly report. Here, they show a slight growth in Europe and the US, while Asia, which mostly represents China, is declining by quite a bit compared to the last year. And this trend has even increased in the second quarter compared to the first quarter of this year. The revenue in Japan, on the other hand, has grown significantly. Unfortunately though, Japan makes up only a small portion of their total revenue, so this growth only has a limited effect on their overall numbers. Also, this revenue growth in Japan is partially linked to the decline in China, as with the declining value of the Japanese yen, many Chinese customers choose to travel to Japan for shopping and just buy their handbags or watches there. So I would expect that this is only a temporary effect. When shown in absolute numbers, this means that the revenue, operating profit as well as net profit have declined on a year-over-year basis. And this is not only due to the declining sales numbers, but also exchange rate effects that have affected the company negatively. What I find interesting though is that despite the slower sales and revenue, their operating cash flow is still quite a bit above the level of last year. The main reason for this is lower operating investments. But the operating cash flow numbers for the full year last year have been quite a bit higher than what you would expect from these half-year numbers. And with more than 8 billion, was much higher than double this amount. So, on a full year basis, we still need to see how the company compares with last year's numbers. LVMH is paying a steady dividend with almost 2% yield. They could also grow this dividend with a nice double-digit growth of 16.7% annually for the last 5 years, while still keeping the cash flow payout ratio at 62%. The current dividend yield sits around half a percentage point above their 5-year average. So, if you believe that the company will recover and continue the past growth trajectory, now could be a great time to lock that in. And the company is not only paying a dividend, they are also buying back shares, although not on a regular level and not in huge quantities. Over the last 5 years, the average share dilution was at minus 0.16%. This might not sound impressive, but it's still better than issuing new shares. Despite the dip in stock price, the valuation when compared to the sector median is still quite a bit more expensive. We have a PE ratio of 24, an EV to EBITDA of 15 and price to cash flow of 70.7. Compared to the direct peers Hermes and Kering, the valuation of Hermes is still double that of LVMH, and Kering sits at roughly the sector medians, even a bit below that. But when we look at their own history, we see that the current valuation is quite a bit cheaper compared to their 5-year average values. In fact, here we have a discount of around 10 to 15%. Going forward, the company will keep focusing on enhancing the quality and desirability of their brands and think that they are in a good position to keep their leadership position in luxury goods. Honestly, this sounds like the typical management blah blah, but it also shows that they don't see any issues with their business model or their brands, and that they expect their revenue to recover again together with the general economy, especially in Asia and China. And this also seems to be what analysts think. Based on the forecast of 25 analysts, the average 1-year price target is at $829, which is around 15% higher than today. They also expect the EPS to grow with a CAGR of 5.84% until 2027 and the revenue still with 4.5%. I've been watching LVMH for quite some time already. I find the luxury segment in general a very interesting one. And I also think that this pullback will not last forever. The change of directions of China's government could be a trigger for the stock to recover. We already saw the effects of this on Chinese stocks in the last weeks, and even LVMH stock did jump by 15% in late September, but pulled back a bit shortly after that again. So now might be a good time to enter a position. My next company is also one that I have on my watch list for quite some time already and was actually one of the first ones I analyzed on this channel. I am talking about ASML. They are providers of high-end photolithography machines that are used for semiconductor manufacturing. They are the market leader in this segment and at the moment the only ones that can produce EUV machines that are necessary to produce the most advanced chips. This makes ASML the embodiment of a pick and shovel salesman for the semiconductor market with customers like Samsung or TSMC. Recently though, they have faced headwinds from rising geopolitical tensions and from export restrictions to China. But over the last 10 years, ASML had a very nice run. They could produce almost 900% returns in this time frame and have easily beaten the S&P 500 as well as the Nasdaq. I made a video about them in December last year and since then they have produced around 10% returns. But this is after a huge rise of the stock price, which they gave up almost completely again over the last 3 months. And that is also the reason why the 1-year stock performance looks a lot worse. But don't let the huge dip fool you. In the last 12 months, they could still outperform both indices easily, which is not an easy task in the best year the S&P 500 had since 1997. The company could still deliver impressive 41% returns as of this recording. But this is actually not so special when we look at the peers of ASML. Both Lam Research and Applied Materials could still beat ASML over the last 5 years with only analog devices lagging behind. But we also see that the 3 top contenders are quite close together and over the course of the last 5 years, they switched their positions several times. So this current weakness could either present a great buying opportunity for ASML or it could also indicate troubles going ahead. In their second quarter of 2024 that they reported by the end of June, the sales numbers from this year have been lagging behind the numbers from last year quite a bit. This, combined with the increased R&D costs, has resulted in operating income and net income that was quite a bit below last year's numbers. But when comparing the numbers from the last 2 quarters, the trend is already pointing up again. The Q2 numbers have been quite a bit better than the Q1 numbers across the board. What I find especially interesting is that despite the export regulations to China, the shipments to there have significantly increased over the last 2 years. And we can also see this in the cash flow numbers from the last quarters. While Q1 of this year was the worst of the last 7 quarters, the second quarter this year was already much better with significant improvements to the quarter before and also Q2 of last year. ASML is a steady dividend payer with a small yield of 0.81%. They could grow the dividends by over 23% annually over the last 5 years, and the current cash flow payout ratio is at 71%. As we can see in the dividend yield graph here, despite the recent dip in share price, the current yield is still a bit lower than their 5-year average of 0.88%. One thing that I would like to note about the dividend growth is that as a Dutch company, ASML reports their numbers in euro. They also pay the dividend in euro, so if you look at the payments in another currency like USD, the picture might look a bit different, as you can see here in the growth table of Seeking Alpha. Here it looks like the company has decreased their dividends a couple of times, which is not actually the case, but just an effect of changing exchange rates. This is quite an impressive dividend growth, especially when we consider that the company is not only returning money to their shareholders via dividends. They are also buying back shares on quite a high level. Over the last 5 years, they bought back 1.3% of their shares on average per year. In the last quarter alone, they purchased shares for a total amount of 96 million euros, and the current share buyback program is still going on at least until 2025. Same as the dividend yield, the valuation multiples of ASML are not cheap. The PE ratio sits at 45.1, the EV to EBITDA at 35.4, and the price to cash flow at a whopping 60.6. This is all quite a bit above the sector median. When comparing the current valuation to its own history, it is roughly on par with the numbers from the last 5 years though. So, the recent dip in stock price has just pushed this to rather normal levels from the quite elevated ones that the company showed earlier this year. So even though the company is not very cheap, this could represent a good buying opportunity if you believe in the long-term success of ASML and think that they can recover their financials again, which I find not unreasonable since the semiconductor market is a very cyclical one that is currently in a downturn. The company's own management for sure believes that they can recover again, and the numbers should go up in the next quarter already. Despite the slightly higher target for Q3 compared to Q2, they still see the outlook for the full year 2024 unchanged and only expect a bigger recovery next year. This is actually also the expectation of the analysts who cover the company. The 1-year price target based on 29 analysts see an average upside of over 30%, while the downside risks seems very limited. They also expect the EPS as well as the revenue to continue growing again from 2025 onwards, with an annual EPS growth of almost 20% and a revenue growth of around 13%. This would actually be around the levels that we had over the last 10 years. ASML has a crazy year behind them. They have struggled with declining sales during a difficult economic environment that has left their stock price falling by more than 25% in the last few months. But their products are as good and essential as ever, and the long-term growth drivers are still intact. So I think that this current dip presents a very appealing buying opportunity, even though I would not rule it out that we have not seen the bottom yet. The company will report the next quarterly results next Wednesday on October 16th, and I'll definitely keep an eye on the outcome and see if their expectations so far have been correct. And before we come to my last pick, if you find this video interesting, please hit the like button and subscribe to the channel so you don't miss out on the next one. It would also be very interesting for me to see if you are already invested in any of today's stocks and what you think of them. So please let me know your thoughts down in the comments below. The last company that I have for you today, and that might be a bit of a sleeper stock, is, and I'm definitely going to butcher the name here, Bolsa Mexicana de Valores. What a difficult name, but damn is it fun to say. This is Mexico's main stock exchange with the US ticker of BOMXF, and they are crucial for Mexico's financial system. The company was founded in 1894 already and is now the second largest exchange in Latin America. In the last 10 years, the total return wasn't too good with only 86% and has lagged behind the S&P 500 in red and the Nasdaq in blue again by quite a bit. The stock has lost some of its ground since its highs in 2020 and has mostly traded sideways since then. Over the last year, the picture is very similar, and with under 5% returns, investors in the company had a rough time. When we compare the 5-year performance to some of its peers, like the Brazilian exchange, Brazil Bolsa in purple, the Singapore Stock Exchange in red, or Deutsche Börse, the German stock exchange here in green, the performance only looks a bit better. While the Singapore exchange and Deutsche Börse could still outperform Bolsa Mexicana by quite some margin, the Brazilian exchange has performed even worse. The financials have also been going mostly sideways since 2020, and the numbers from the last quarterly report also seem to indicate that this will also be the case for this year. But the long-term trend is pointing nice and steadily upwards, and the 10-year growth numbers for revenue, net income, free cash flow and EPS are still all between 6% and 9%, which isn't too bad when you consider that there was basically no growth in the last 4 years. What makes me think that the company could escape this stagnation soon is, at first, the trading volume that has increased quite a bit since last year. And in fact, the average trading volume of shares traded in 2023 was almost 10% higher than in 2019. For completeness sake, I want to mention that the volume in 2020 was still higher than today, but this was when COVID happened and everybody first sold their stocks, only to buy them back later in the year, which resulted in a sharp spike of trades. There is a great article on Seeking Alpha that goes much further into the details of the growth potential, including Mexico's economic fundamentals, the trend of nearshoring, the current political environment in Mexico, and the behavior of foreign investors in Mexico and Latin America. I am usually very hesitant to recommend any articles from Seeking Alpha, because many of them are poorly researched and only focus on one factor. But this one is quite detailed, and I highly recommend checking it out if you want to dive deeper into the potential of this stock. I'll put a link to it down in the description below. Bolsa Mexicana is paying a huge dividend with a yield of 6.5% that they could grow with 4% per year over the last 5 years. And while this is quite a bit lower compared to the crazy dividend growth of our other two companies today, it is still not too bad with such a high dividend yield. This yield is also close to the highest levels they saw in recent history and currently sits around 20% above their 5-year average. And this comes in addition to the share buybacks that the company also does. Over the last 5 years, they could buy back 0.81% of their shares annually. And this share buyback also makes total sense right now because the company seems to be quite cheap. The valuation compared to the sector median is quite a bit lower, at least in PE and EV to EBITDA. The price to cash flow valuation is about the same level though. And when we compare the valuation to their own recent history, it sits well below their 5-year averages. So the company is quite cheap on all fronts. But as we know, the stock market always trades the future. So let's take a look at the expectations for the next couple of years. The average 1-year price target based on 8 analysts is over 15% higher than today, with a maximum upside of over 40% and a downside of 8%. So these analysts definitely see more upside potential than downside risks. They also estimate an EPS growth of 5.4% annually until 2027 and a revenue growth of 5.3%. This is both well above the growth numbers from the last 5 years. Overall, I think it's a very interesting stock, especially for investors looking for high dividend payments. But before investing, you should definitely have a deeper look not only at the company, but also at Mexico's economy. And of course, that is true for all companies in today's video. I mean, the deeper look part, not the Mexico's economy part. This video is not meant to be a conclusive stock analysis. I just wanted to share some stocks that I currently find interesting with you, and before investing, you should definitely do your own research. But if you are interested in a deeper stock analysis about a compounder with insane growth potential, check out this video of a stock that I currently consider buying myself. That being said, thank you so much for watching, guys. and see you in the next video.